You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koos, president and portfolio manager at Libertas Wealth Management Group at libertaswealth.com.
Hey everybody, I'm meeting today with Brandon Caldwell with Ruoff Mortgage. And this all started because I was reading a statistic about not only home prices and interest rates going up and what that's done to mortgages, but also some new regulations that recently went into play that make it a little bit tougher for people with good credit scores that are good savers to get mortgages, while making it a little bit easier for people with lower credit scores who aren't as good as savers at get mortgages. And I thought that was really interesting. I didn't completely understand it, so I thought, why not do a podcast? So that's what we're talking about today, at least some of what we're talking about today. We've got a bunch of other strategies we went over. The conversation was a lot of fun, but Brandon has over 9 years of experience, primarily in senior advisory roles within the mortgage industry. Super passionate guy, really loves what he does. Went to Mount Vernon Nazarene for his undergrad in business administration. Then he went to Purdue Global for his graduate degree. He's a girl dad. He's got 3 daughters that play soccer, basketball, and they're in gymnastics, which means he's very busy over there in his own little estrogen ocean. But the big things about today, and what I really love about Brandon, he's somebody I recently met actually just this past year, is that you can just tell, and I know you can tell as well if you're listening or watching this, you can tell when somebody's really passionate about what they do, because it's like the work and the research and the things they're doing it for fun. They're doing it in their free time, so they become kind of a subject matter expert, a thought leader, if you will. I know that's become a buzz phrase lately, but truly, Brandon is really passionate about what he's doing. Clearly, very good at what he does. And today we had a great conversation talking about a lot of different things in the mortgage industry, including prices going up, rates going up, when rates might come down, why the rates would come down. We talk a little bit about buying a second property in Florida or other locations that make it a little bit tougher because investment property has made it, it's tougher because rates are higher to buy investment property than they've been in a long time. In fact, I think your mind will be blown when you hear that. But let me shut up and introduce Brandon Caldwell with Ruoff Mortgage. I hope you enjoy the conversation as much as I did. All right, everyone. Today we've got senior mortgage advisor Brandon Caldwell with Ruoff Mortgages. We're going to be talking about all kinds of things, some kind of controversial things that have happened in the mortgage market this year. I just got off the phone with somebody earlier today, Zoom meeting actually, talking about how they want to purchase a home, but the mortgage to buy that home is a whole lot different than it was a couple of years ago. Obviously, their home's worth a whole lot more than it was a couple of years ago as well. But there's a lot of changes that have occurred in the market, not just with real estate, but with mortgages and so on, due to interest rates, but also due to some regulatory changes from a government level. And you need to know about these changes. So, Brandon, thank you so much for joining me. You're definitely the expert here, not me.
Thanks for having me.
Oh, for sure. Well, let's just start with the biggest one that you and I started talking about when we met for lunch a few weeks ago. And that is, I noticed, or I just kind of caught wind through some of the things that I read on a day-to-day basis about this thing where it seems like there's different I don't want to say home prices, but there's different benefits, it seems to me, that are being given to some over others. And I think, correct me if I'm wrong here, because I don't want to say this wrong, but from what I understand, it looks like people who have been to better savers, who have higher credit scores, seem to be maybe, I don't know, the new rules are hurting these people who are better savers, who have higher credit scores, and those same rules, or rules in the same bill that went into effect, I believe, March 1st, if I remember correctly, are actually helping people with lower credit scores who are not as good as savers. So if I'm an investor, or if I'm a home buyer, and I've done a really good job of saving, that it's actually harder for me on an exponential level than it used to be. Can you kind of explain this in terms that I can understand, let alone my clients?
Sure, absolutely. Yeah, there's been, in our industry, we call them loan level price adjustments. And there's been some new loan level price adjustments that have been enacted. And what that has done is it's taking your typical borrower with a higher credit score that's putting anywhere from 10 to 25% down, and it's impacting them negatively. It's costing them a little more to receive that mortgage than if they had a lower credit score and were putting less money down. A great example, if you want to pull the chart up, we can take a look and see kind of, exactly how that's hurting some of high net worth clients with good credit scores. Typically, if you take a look at the 740 to 759 credit score band, if they're putting 20% down, that is now 0.75 adjustment negative towards them as compared to last year. So for every $100,000, that's $750 that they're going to have to bring to the table for an upfront fee or get absorbed into their interest rate, thus increasing the interest rate for that borrower. Now, on the flip side, if you look at a borrower with just a 640 credit score that's only putting 5% down, they're receiving an increase on pricing of 1.25%. So for every $100,000 of their loan amount, they're receiving a bonus of $1,250, bettering their interest rate or bettering their closing costs.
Interesting. And by the way, this chart will be for those of you listening on iTunes, on Spotify. We are going to have our production team put up this chart so you can see what we're looking at. And as I'm looking at it here, just to make sure everybody understands, so if we look at the 740 to 759 credit score on the left there, and then you scroll over to where it says 80.01 to 85%, that's the inverse, obviously, right? So that'd be like 10, call it 15 to 20% down, correct?
Correct.
Okay. And so you're saying that basically they're getting penalized to the tune of 75 basis points or 0.75% because I've got a credit score of, let's just say, I don't know, 750. Yep. But if I have a credit score of 645, then not only am I not being penalized, but I'm actually getting a credit almost twice as much as the penalty that are being paid by those with a higher credit score. Am I understanding that right?
That's correct. Yeah. So it's kind of, one, you think, unfortunately, that money is going from that borrower and it's helping fund the next borrower down the line.
Interesting.
Kind of how I look at it. I do have a workaround for that. I recommend.
I like workarounds.
Yeah, a good workaround is you can do a recast, and what that is basically if you are in the market to purchase a new home, just put the 5% down. Let the loan settle for 60 days. Take the rest of your funds, and then make a big lump sum payment and do a recast on your loan. Typically, there is a recast fee, about $250. And then they'll redo your loan and they'll drop your loan balance. And that'll kind of get you around those loan level price adjustments. Some lenders, unfortunately, don't allow recasts. So it's definitely something to ask about when you're shopping for your new home. But that would be a workaround for this.
So I didn't even know there was a workaround. So this is already valuable to me. So for those of you listening, watching, what I'm hearing here is that the cost of redoing the loan and with a lump sum later is a whole lot less than paying $750 for every, what, 1,000 you said?
For every 100,000. Yeah.
For every $100,000 in home purchasing price. That's a no-brainer to me. Yep. Wow, that makes a whole lot of sense.
Yep.
Okay. All right, cool. Well, what about so the FHFA, targeted home second home adjustments? We were talking about that earlier. This is confusing to me because I don't understand why they're doing this. Can you first explain it again in layman's terms, and then let's talk about the why, if there is one.
Sure. I think if we roll back, right before COVID, interest rates were in the high twos, very low threes, depending on who you were working with, and it was a great time. Housing was as affordable as it could ever be. Right. It was super affordable. You had $800,000 houses were only costing people, $3,500 a month with taxes and insurance. It was a great time. So if you had a property, refinance it, you won. And then everybody said, hey, my primary is so low now. Let me go buy a second home. Let me buy a home I visit, once or twice a year and Airbnb it out. And then what happened was the vacation markets exploded. So everybody was purchasing a second home.
Sure.
In Florida or California or somewhere warm, the Carolinas. And then, the Federal Housing Administration kind of said, hey, we need to pump these brakes a little bit. So April of 22, they rolled out an adjustment for second homes that basically make them price as they are investment properties. So if you look at the Florida market now compared to 2 years ago, everything's for sale because interest rates are no longer in the threes, for those secondary properties.
Okay.
But even worse off, the interest rates are actually, pricing in the 9% range if you can find a banker to even go that high. Most of the time, the rate sheets shut off around 7.5, maybe 7.75, because no investors will purchase a loan higher than that. And then the rest of those fees are getting thrown into front end points.
So is Florida a liquid market now on the sell side?
It's starting to turn awful red with a lot of things for sale.
Interesting. Okay, but if I want to, but it's really only beneficial, it sounds like, if I want to sell my house here and move permanently,
Correct.
not so much buy a vacation home. You say 9%?
It would be, yeah, very. If you could find an investor to go that high, like most
Oh,
investors are going to tap out in the high sevens, and you'll probably see about 2.5 to 3 discount points on the front of that to make up for those adjustments for the second home.
okay. So anybody who wants to buy a second home, vacation home, even if it's an Airbnb rental property, doesn't really make a difference. Second home,
Mhm.
they're going to pay what, 2.5, 3.5% higher.
Yes,
Now, why
sometimes
would they
could
do
be
this? I don't understand why. That I would think that'd make it even more difficult. Well, obviously, it makes it more difficult to buy. That's not gonna. I mean, obviously, it's not gonna, you know, help the Florida home economy. That's for sure.
Mhm.
But what will be the purpose, if there is one, I guess, of creating such limitations?
I think it was just, the initial phases to try to pump the brakes on the housing market. Obviously, they saw, potentially back then inflation was starting to creep up. This was the first step with the second home adjustments to try to slow down the housing secondary market for the second homes. That didn't work. That adjustment is still into place. Now obviously they've been raising the prime rate up. That hasn't slowed inflation as quickly as they would like. And then now, but the first thing we talked about was the new loan level price adjustments. Those went live about a month and a half ago. So that is the third lever they've pulled to now slow down this housing market a little bit.
Okay. So again, if you're moving permanently, you're retiring, and you're like, I'm done with these Ohio
Mhm.
northern, to call it Northern American terrible cold sub-zero temperatures, and you're moving permanently, then it's not going to hurt you. But if you want a second home, then
Mhm.
you might want to pump the brakes, and for good reason. What about
Well, I
Sorry, go
think
ahead.
it's a good barrier. Like anything, it's a barrier to entry right now.
Hmm.
So if you can stomach that adjustment, or if you are making that move, I think it's a great time to hop in and get something while there's not as much demand. You just have to weather that storm until you can refinance it to a favorable interest rate.
I was just going to say, yeah, if you
Yeah,
if
it's
you
kind of think of
buy
it
your
as a.
vacation home now, while as prices become more depressed as a result of higher rates, only to refinance later, whether either because rates go down, perhaps, or because you decide in a year or two or three or five that you are retiring, and then you want to sell your home up here and head down there.
Mhm.
That would make sense.
Yeah,
What
great
about
great time to have cash and buy a
yeah,
second home in Florida.
cash is king, as they say, right? It almost always is, until you get the gold bugs and the U.S. dollar bears jumping on the bandwagon. Which, by the way, I do think the U.S. dollar is going to go down, but I do not think it's going to collapse. Oh my God! If I had a nickel for every newsletter that was sent my way. I digress. All right. So, next topic here, a question I've noticed, and it's not. I think some of it's probably the price of commodities coming down, lumber, things of that nature. But the new home building, it doesn't seem to be slowing down all that much. Um, Interest rates. What are you seeing on that side of the fence?
New home building is very interesting. This housing cycle go around. So in 2008, when housing slowed, home builders dropped prices, and then secondary homes, so existing home sales followed suit. This go around, builders kind of have taken a different tune. They said, "Hey, the average interest rate in the market right now is anywhere from 6.5 to 7.5%. Given on the day, let's not cut our home prices. Let's offer a lower interest rate." They've got home builders offering interest rates below 5%, and they're pushing, instead of lowering their home prices, they're pushing all those funds into the interest rate, making it very affordable for the buyer. But I don't think the average buyer understands that, basically they've purchased a home $30,000 over what they should have, and they've indirectly bought down their interest rate to 4.99.
So just using the extra money from the sale of the home to buy down the points.
Correct.
Interesting. So
Correct.
you think you're getting a better rate, but really the discussion was never had.
Discussion was never had. And the builder can do that because
Interesting.
they're the seller. Seller can pretty much do anything they want.
Yeah, I can sell it for whatever they want. Yeah, whatever price they want. That's a little interesting.
It
I'll just
is.
use the word interesting.
It's very interesting, and it's. I don't want to say there needs to be an ebb and flow of things, and I think that's one of the levers that haven't fallen to allow housing to kind of adjust itself naturally to the market. So it is very interesting what's happening with existing home sales that are already built. We're just kind of stagnant and sitting because inventory is very low, but you've got the new home builders just throwing that wonderful interest rate out there. But and that money's coming from somewhere.
I mean, you find out eventually. I mean, you sit down at closing, and all of a sudden, somebody who's at the title office says, "All right, and this is the line item to pay for the points." And you're like, "Wait a minute, pay for the points? What's that mean?"
Yeah.
Like, well, it's to buy your points down to get your rate down to where it's at, and you think, "Well, wait a minute."
Yeah.
But it's kind of too late. I mean, you just went through for some an enjoyable process, for some maybe a not so enjoyable process of building a home, which is depends on the person in question and what your experience was. But you certainly don't want to change your mind when you've gone through that process, right? You're probably trying to get out of your current home, or you're in between homes. You're living out of an Airbnb, perhaps.
Oh
So
yeah.
not the best time to be making big changes and decisions.
No, no. That, and I'm sure there's a big deposit that's put down on those new builds now as well, and you can't walk away from that.
So there was back in the day, pre financial crisis, 2007, 8, 9. There was all those 3-1 buy down, 5-1 buy down mortgages. There was interest only. There was all these different types of mortgages, and I think a lot of that was very much kind of lopped off quickly in order to kind of stop the bleeding. And as time's gone on over the last, call it 15 years or so, it seems that there's a lot of other not so well known programs out there that people just don't assume, they assume they don't exist.
Mhm.
Now, I don't know what they all are, nor do I understand exactly how they all work. However, what are some of these ones you were telling me about? Bank statements, no doc, DSCR. Just go through as many as you're comfortable and explain the
Sure.
pros and cons.
So one of the things we've noticed, and I'll preface the bank statement loans, the no docs, and the DSCRs. Those have been around for a little while. But however, I've noticed since housing has slowed down a little bit, some of these other programs, 80/20 purchases, where you can do an 80% down, 80% first mortgage and a 20% second mortgage. So basically 100% financing. Some of these crafty things are starting to come back because they're trying to pump up demand on the lending
Interest
side.
rates are higher too. Yeah.
Yeah, so things are coming back. But yeah, so some programs folks don't know about is the bank statement program. So if you've got a self-employed individual and they write off a lot of things, while that's great for income tax purposes, it makes it extremely difficult to purchase a home or qualify for a real estate transaction. So what we can do on the lending side is we can do 12 to 24 months of bank statements, and then we'll take an average of those deposits, and then we'll do a 25% haircut on there for normal taxes, and then that will be the monthly gross income, and we'll use that to qualify
I
for the
see.
home loan. Now, is that going to price out as good as a conventional borrower with a W-2? Absolutely not. But there's a risk for that, program, and it's priced inappropriately, and that's an avenue for somebody to buy that technically couldn't. Also, a no doc program. Again, there's a risk priced in for that program. So think about an individual, same situation. Maybe they can't qualify for that bank statement program, or they have some other situations have gone on. They've moved money around too much. They need a no doc. So they've got a very high credit score. They've got a lot of cash on hand. So we'll use that high credit score. We'll do first page of a bank statement showing what's in that account, 15 to 25% down, and they're able to purchase a home. So, fantastic. Now, again, much higher interest rate than what your normal 30-year fixed borrower with a W-2 is going to receive.
Now, is that going to be no doc? Is that better for somebody who is maybe retired or somebody who doesn't have much income, but they have a lot of assets and a good credit score, just not a lot of credit per se, or income or sources? Or
No, if they have a lot of assets, Fannie and Freddie have a program where we can total up all the assets of a retired individual. And then even if they're not withdrawing on those, we can, again, apply a haircut to it in a formulation where they were drawing on the money. So I wouldn't use that for somebody, in retirement age. But it might be something for somebody, let's say, who has multiple properties, right? They simply can't qualify for that next property they want to buy, but they want to buy that property for one reason or another. So that would be a good reason for the no doc. Typically, it's something where they're probably going to be walking into some equity, or they have some development plans for it, and it's
Okay.
just too good not for them to pass up.
And then pros and cons or differences between call it case study, I guess, if you will, between the person doing a bank statement versus no doc. What do those people look like? What's the differences between them?
I mean, I think they're going to look similar. Probably the no doc person isn't going to qualify with the bank statements, isn't going to qualify with normal W-2 or tax returns. Potentially has exhausted credit, if you will, on paper, but has tons of cash sitting around and simply wants to move on a property and has plans for it and sees value and equity in it.
Okay. And then the last one, is there just one other? Or?
Yeah, so the debt service coverage ratio. So this is a very interesting one. This popped up on the radar about 3 years ago. Became very hot during right before COVID when rates were in the threes, because you could do this with the rates at 5.5, and we can't even get single family residences at 5.5 right now. So
Right.
What the DSCR loan is basically, if you want to put 15 to 25% down for a property, basically you're going to get an appraisal, you're going to put your money down, and then the appraiser is going to do a rent calculation on the property. And as long as the property should rent for what your mortgage of principal, interest, taxes, and insurance is, you're then qualified for the property. So it was a great way. I mean, everybody should have bought 4 homes in Florida with this.
Now, was this typically for rental property?
It would typically be for a rental property, yes. But, 15% down, you could have scooped up 3 properties in Florida, let them sit for a year, and then sold them and made $100,000 on each. If we only all would have known.
If only, yeah. What are investors doing now? People who are looking for, rental properties. I mean, is that even, I don't know. I don't want to say possible, because obviously people are doing it, so I know it's possible. But what should people be looking for if they're real estate investors looking to buy property, to whether that's turn around and sell for more, which probably is the most difficult thing to do, but to rent it out?
Yeah, I think most investors right now, at least the ones that I'm speaking to, because interest rates are so much higher than where they were, it's having a hard time covering right now in your typical 15% down. So they're really having to put 25, 30, 35% down
Really?
for that property to cash flow. Some investors are fine with it breaking even, but a lot of the first-time investors, they want to see a little bit of profit on that. So with rates where they are, just like commercial, you just got to put more cash in to make the deal work now.
Yeah, I'm more familiar with commercial, to be honest, but that's because I'm a commercial real estate owner and landlord, I guess you could say. But I can understand with the commercial market the requirement to have a higher cash inflow and injection, but to think that for residential real estate that you're needing 20, 25, 30 or higher, that's going to make it tougher. It's definitely going to bring down demand, I would think, if it hasn't already.
Sure. Well, I mean, you think that house, 3 years ago, that house was $200,000 and you could buy it at 5.5 for an investment property. Now that same house is $350,000 and the rate is 775.
Right.
So not only has the rate almost tripled, the price of the property has almost doubled. So, rents went up, but it hasn't gone up that much.
Yeah. When you find yourself in this conundrum as the owner on the sell side going, man, I don't know I want to own this thing anymore, but I've got such a great debt service on it. My rate's so low. I bought it at such a great time, or at least close to a good time. Now I got to pay tax if I sell it, right?
Yep.
But I mean, of course, you could 1031 it. I've done podcasts last year, I think it was October, and live presentations about doing DSTs, 1031s, passive, income, things like that. So that's another discussion for another day. But it's interesting. I guess I hadn't thought too much about the investor or the investor side of the equation.
Yeah, I mean, I think even, you look at the investors, you even look at current homeowners, myself, yourself, we're kind of locked in to our homes right now. It's kind of like, well, why would I get rid of my 275 and go buy something at a 7.5?
Right.
What does that make financial sense? Now, I think, again, if you can stomach it, I think interest rates, when they do come back down, what's going to happen to home values? I think they're going to continue to go back up. Other people are going to hop back into the market. There's clearly a threshold where someone in the threes, probably I'm going to say in the fives, will hop back in the market and make a move. And once all of those things start to happen, oh my gosh, we're back to the races again.
Right. Yeah. I would agree with you there, especially in Central Ohio,
Mm-hmm.
given what's going on here. But around the country, rates come down. There's more debt to income ratio on the top side of the equation available for spending. I'm
Mm-hmm.
assuming that the requirements for down payments would probably go down a little bit as well
Mm-hmm.
at that point. And yeah, more demand, same supply, all things held constant, prices rise, right? That's supply and demand for you. That actually brings me to my next question. I read a stat, this was a while ago now, probably 6 months ago, that between the increase in home values the last 2 years, 2.5 years,
Mm-hmm.
and the increase in interest rates on mortgages, that the average mortgage has more than doubled
Mm-hmm.
for the same house purchased, say, 2.5 years ago. So with that, there was another stat you were sharing with me: 75% of middle income households cannot afford any houses on the market today. What
Mm-hmm.
I'm curious is, what houses are those? And what might you have to say about housing affordability just in general, since rates and prices have inflated so much this past couple of years?
Yeah, I mean, there's no easy way to put that. I mean, housing affordability is at an all-time low right now. And what that means is it's just going to cost more to get in there. It's kind of that opportunity cost. I do think that those folks that can bridge that gap right now, they're going to be extremely happy with themselves when rates do finally drop and they get to refinance and their equity goes up. But in the meantime, that kind of, I think back to like the first house we ever fixed and flipped over in Huber Ridge over in Westerville, right? It was $100,000. I think I bought it from a HUD auction, and I might have paid $72,000 for it. And we put a new kitchen in it, new floors, and sold it for 125. And we were extremely, everybody was happy. That same house is almost $300,000 now.
Wow.
And it's weird to think that over a 20-year span, that house could go for that much money. But those are those houses, and that's where they're at right now. So if you think of how much your first home was when you bought compared to where they are now, I mean, it's
Oh
just
yeah.
it's a little out of whack.
Yeah. I also, another stat I read was the average house in 2022 sold for over $400,000.
Oh yeah, yeah,
And
I've
you
got
see,
one
you
right
say,
here.
you say, oh yeah, but I guarantee you, our listeners and those who are watching this on YouTube are not going, oh yeah, yeah, sure, that makes sense. The average house sold for
No,
more than 400 grand.
no, here's a good one. So quarter two of 2020 for the U.S., the average home sale was three hundred twenty-two thousand
That's
six
still a
hundred
lot.
dollars.
That's still a lot.
That is a lot. But quarter four, 2022,
Okay. Ooh,
$479,000.
average,
So
average.
we're talking 2 years and two quarters, and we're up, $150,000 nationwide.
Yeah. I always like to tell the joke about the guy who drowned in a river that was an average of 4 feet deep.
Yeah,
That's the joke, right? Um, but it's still 470. That's a lot of money. I
it's
mean,
a lot.
it just goes to show. I mean, not to sound like such a cynic here, but it does goes to show how much our dollar has eroded over the years. I mean, in terms of how far to go, how far you can stretch it. So there's going to have to be a mean reversion at some point here. So, I mean, what do you say? You mentioned interest rates going down a couple of times now.
Sure.
What do you what do you think the reason would be? I'm not going to make you do the crystal ball thing because I don't like it when people do that to me. But what do you think? What the reason will be when interest rates do come back down? Let's just say, not to say they have to. I should say if. So what
Well,
the question is, if they come down in the future, what do you think is the most likely reason they do?
I think they're going to come down in the near future, and hopefully towards the end of this year, we'll start to see some relief. It's basically pegged on the inflation numbers. So once
Mhm.
we start to remove bad inflation numbers and input good inflation numbers, which I
Happening
believe
every
we
month.
just started with today,
It
as
was
well
big.
as the consumer price index, we're going to start to see some relief on the interest rate.
And by the way, this is being recorded on Thursday, June 13th, by the way. So when this gets published, we're talking about the CPI number that came out June 13th in the morning, which obviously replaced the June CPI number last year, which was a very big number, almost cut it in half, honestly. So by the time listeners will be listening to this right now, we'll already know what the Fed did. So
Yeah. And so the Fed should not raise tomorrow. However,
there's your prediction.
yeah,
Well, no.
they potentially, are going to raise again. But once this inflation starts to get tamed, I think those interest rates are going to start to come down. When those interest rates start to come down, unfortunately, then home values are going to start to go back up, and individuals are going to start to get back into the market. It's going to get feverish. We briefly talked about Florida and some of those heavy secondary home markets. You are seeing some prices really start to decline in those markets a little bit. Your Phoenixes, your Californias. However, we've got this, big looming Intel coming into Ohio, and
Right.
we're just moving sideways here in the Columbus market. So, values aren't going down. Homes aren't flying off the shelf. They're taking almost, 20 to 30 days now to get in contract, but they're still getting that high dollar amount. So I don't think we're going to see, a correction at all. And I won't even say big. We might not see any correction of pricing in Columbus because the demand for housing is so great with Intel coming in.
Yeah. Yep. That makes sense to me. What do you say to that person though that says, well, I don't want to buy a house because I want to wait for rates to come down.
Mhm. I think the conversation I typically have is, okay, right now the market's not as hot as it could be, and you're out there fighting with 10 or 15 people. If interest rates come down, how many people do you think you're going to be out there bidding against? And we're going to be out there bidding against 30, 40, 50 people again. You're going to
Right.
see homes with 40 offers again. It's going to be cash is going to be king, appraisal gap. I mean, we're still doing appraisal gap for a ton of our offers. I'm not seeing them 20, 30% over list price like I was at the height of it, but I'm still seeing 10 to $15,000 on a normal offer.
Yeah. Wow. That's
So,
wild.
so I think, if you're a down payment assistance buyer, if you've got limited cash on hand, if, like I said, this is your time to buy. If you can stomach the higher interest rates, secure your house now, pay a little bit more in interest than you should, take advantage of that refinance, and your house is already secured. You'll be so happy with yourself in the future.
Yeah. It's almost like there's this unknown break even because there's really no way to calculate it without predicting the future. But there is this unknown break even between um, the the lesser cost in, say, a mortgage payment because of a lower rate, but the higher cost of the house because
Mhm.
of appreciation due to lower rates. Does that make sense?
Oh yeah.
Yeah.
Yeah, I mean, I definitely think when the rates go down, I mean, the appreciation is going to outweigh that extra $150 a month
It could move pretty quickly. That's for sure.
very quickly.
Especially since there's this pressure cooker of people who want to buy homes who are maybe kind of sitting on their hands right now, waiting for things to get better. It could be like in my business where, people say, well, I want to buy right now because I want to wait for things to get better. So they're waiting for stock prices to go up before they buy. And when prices go up in the stock market, they'll say, well, I don't want to buy right now. They're too high. I'm going to wait for a pullback. I want to wait for a market correction.
Yeah.
And then there's a market correction. Say, well, things are bad right now. I want to wait for things to get better first.
Yeah.
And it's this cycle, right? It's the same. It's similar in the housing market, not exactly the same, but
Well, and there's your point. If you're never in the market, you can never take advantage of the high or the low. So you've got to get in, right? No matter what
yeah,
market it is, you've just got to get in it. And then, as we say in housing, if you move within the market, you're moving within the market. So if housing crashes, right, and my house goes down 200 grand, the house I'm buying has went down 200 grand. It
that's
is,
right. On a pro
it,
rata basis to a certain extent, yes.
yeah, it is. I'm moving within a market within a certain amount of time. I'm not affected.
Right.
I think it's when you hop out and you wait, you try to time something, that's when you end up, missing out.
Well, I have way more stories about people missing out for long periods of time and missing out on so much opportunity cost. I have way more of those stories than I do about people timing it near or at the bottom of the stock market or the bond market or commodities market. And when that happens, I think everybody agrees it's pretty much a luck. I mean, don't get me wrong. There's nothing wrong with a little bit of luck. I have no problem with a little bit of luck. But I've got stories of people who sat on their hands out of the stock market in cash for more than 10, 11, 12 years, waiting for prices to get lower before they'd buy, and then still sat on their hands for too long. It's terrible. It's terrible.
Oh,
So you're right. I mean, it's obviously homes are a little bit less of a liquid investment, less liquid than hitting the buy and the sell button on a stock or an ETF, let's just say. But yeah, as time goes on here, I think that the only other thing people need to consider, and tell me if I'm wrong, is, right now, if they're looking to buy a home, making sure they can afford it. I think you have to make sure you can afford the payment. I don't think that you take this podcast or the information we've been sharing and say, oh, well, prices are probably going to get higher, so I think I need to buy now, even if I can't afford it. Because that could become a problem, whether it's because, you lose a job, something worse happens, you don't have the income to pay for it, now you're foreclosing. Or another situation I've heard a couple times is, well, I can't afford the dream home, so maybe I'll just buy a home right now for the next 2 or 3 years and I'll sell it and buy the dream home then. It's like, well, again, back to break evens. Tell me if I'm wrong here, Brandon, but I mean, don't you have to own a home for a little while longer as a rule of thumb than to just buy a home, sell it after a few years and hope that you're going to break even?
Yeah, I mean, there's definitely costs to sell the property.
Mm-hmm.
There's costs to get your loan. There's you have to factor those costs in. Now, we did have a year with almost 35% appreciation. So, I mean, I guess
There's
you could
that.
have one of those, but I certainly wouldn't use that as a real estate, forecasting metric. But getting in a home, waiting for your dream home compared to getting in a home now that fits your family needs, I think I would definitely get out of that apartment or get out of that rental situation, because you got to remember, when you're renting, that interest rate's 100%. You're paying someone
Oh,
else's
yeah, for
mortgage.
sure.
So I definitely, wouldn't sit on the sideline for a dream home. If you had a home that checked almost all of your boxes and fit your family's needs, I would jump into that today.
Yeah. What about one last question for you? What about the people who sold their homes? They're kind of sitting on their hands purposely because they're in between homes, but they weren't ready to buy their vacation home or their, not when I say vacation home, I mean their retirement home, not vacation home. So I sold, my Columbus primary residence at a good rate. I'm renting right now until the right time that I feel like I want to move to Florida, Phoenix, whatever, Scottsdale. Do you have an opinion there?
I would just put that money to work somewhere. Don't let it be dead.
Okay. Yeah, that's fair.
I mean, if you can get in 4.25, 4.75 somewhere with it, all right, that's fine. But gosh, don't let it sit in an account at 0.01%.
God, man, it's sad that those still exist even, isn't it? Banks are making money on that, I'll tell you. But well, Brandon, thank you so much for joining me. If those of you who would like to get a hold of Brandon, have questions for him about your personal situation when it comes to buying a home, selling a home, mortgaging, his last name is Caldwell, Caldwell. So Brandon Caldwell, he can be reached at brandon.caldwell@ruoff.com. That's RUOFF.com. And of course, their website is ruoff.com. You can go to their website instead. I'll put the contact information. Our team will put the contact information for your phone and everything inside the podcast notes. So you'll see them there. But that's it for today's show. So feel free to share this episode. Please share this episode, especially with what's going on in the market right now with your friends and family. And if you'd like to discuss your personal situation further, having to do with mortgages or anything else for that matter, you never have to be a client to ask a question. If you'd like an intro call to discuss your financial situation, your retirement plan, get a second opinion on your retirement plan, head over to libertaswealth.com. Click on that button that says click here to get started. You'll go through a few questions, and then somebody from our team will reach out and set up an intro call on the calendar with me. Be sure to subscribe on iTunes, YouTube, Spotify, and remember, you can sign up at libertaswealth.com, not only to get these updates, but we also get the access to screencasts, videos, articles, and other things that we send out on a regular basis delivered directly to your inbox. Follow us on Facebook. We're at facebook.com/LibertasWealth. I'm also on Twitter at Adam Koos. That's Koos, as well as Instagram at AdamDKoos. And as I always say, there's thousands and thousands and thousands of podcasts out there, obviously, these days. And you chose to give ours a listen today. So thank you so much for joining us, and we'll see you next time.
Yeah, thank you.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.